Welcome everyone. We're doing a mortgage and interest rate update. One for, mostly a strategy thing to talk about, what the play is, what to do, lock in or stay variable or vice versa to do with 2025 and talk about the most recent quarter point change today and what we think is going to happen in the future. So I like to bring Dan on for these kind of updates. He's great at keeping us in the loop. And I asked Lorenzo to come on too, since CMHC with their MLI program has become a better part of the conversation. I've been using them and it works. So it'd be nice to hear about what CMHC is doing and what their rate outlook is. So sorry about the lighting, as best I can do on my end, but I'll let Dan kind of jump in and take over here.
Awesome. Awesome. Well, I appreciate it very much. I've got my right-hand man, Lorenzo, here with me as well. I handle Lorenzo and I are business partners, along with, Dave, if anybody remembers Dave. But I handle a lot of the sales. I handle a lot of the front end stuff, a lot of residential. And Lorenzo handles a lot of the operations and a lot of the commercial stuff when it comes to multi unit financing and CMHC and bridge loans and all that stuff. So thanks to Paul for having us. Never to me, honestly, this is a good group. I like an intimate group, so I'm glad. Under 15 is a good number. This way we can keep it more nonchalant in a sense. If anybody wants to jump in and ask questions, or Paul, do you have some sort of format structure that you want to stick to?
No, I'll let you roll through and then I'll ask you a few questions. And
Okay.
then there's about 20, 22 people who are waiting for the recording. So,
Okay, cool. So I've got about 20, 30 minutes where we'll go over, basically interest rates. That's obviously a big question. It's very confusing. It's very volatile right now. So I thought we would talk a little bit about where interest rates are, where they're going, what rates I would pick, what we're seeing in the market, some of the changes. I mean, we saw the good news today with the decrease. And then Lorenzo will jump in and talk about the multifamily. Lorenzo, you want to say anything before I get started, buddy?
No, just glad to be here. Thanks everyone for having us. Yeah, I don't want to tie too much time here, but just talking about myself. So no, let's get
Okay.
started. I don't got much.
He's a man of few words. I like it. All right. So let me get my thing ready to go here. Slideshow. Okay. I think I got this. I got to share my screen. Can you guys see that? How about
yeah,
now? Is that the presentation?
yeah, roll with it.
All right. We're good. Okay. So, one thing we have to remember, when we're talking about interest rates, is there's three key components that will influence interest rates, amongst other things, of course. But the three main components that are influencing interest rates are bond yields, inflation, and unemployment, and GDP to some level as well, of course. Um, when you see bond yields heading down and you see inflation heading in a downward trend and you see unemployment heading in an upward trend, these are three signs you're going to see interest rates dropping in your market. And these are things that we're going to go over, and I'm going to show you basically what we see. So, bond yields, okay? Bond yields, first thing we got to know about interest rates is when we're talking fixed rates versus variable, they're not influenced with the same people. Okay, the Bank of Canada is what influences prime rate, right? The overnight lending rate. The overnight lending rate, for those that don't know, that's the rate that the Bank of Canada sets for the banks to basically borrow money from each other, right? There's trillions of institutional capital trading every day. The bank needs to borrow funds from each other to close deals, to invest, to do whatever it is that the banks are doing. So they have this overnight rate. Today, after the drop of a quarter point, that overnight rate is 3%, and prime rate is 2.2% above the overnight rate. And that's how we get to a prime rate of 5.2%. Okay. Now, the bond yields is this is what impacts fixed rates. Okay. Now it can impact variable rates. It can impact the discretion on variable. And discretion on variable, what I mean by that is the discount to variable, right? We hear prime minus 60, prime minus 70. You know, you could have got a mortgage a year ago and got prime minus 90. Well, now you might get like prime minus 60. So these are the things that a bond yield will influence. It doesn't influence the Bank of Canada's prime rate. So this is an interesting scale. If we just bond yields, if anybody has any doubt on whether or not they influence fixed rates, this is a chart of where the fixed rates and where the bond yields were. Sorry, not the fixed rates. This is where the bond yields were basically when COVID hit and we had our interest rates at a low. And you can see as inflation started to creep up, we were seeing increases in the bond yields. And that's why we started to see increases in the fixed rates, 2022, going middle of 2022, 2023. That's when we really started to see fixed rates start to go up, okay? From their lows of like, 1.99, 2.5. So we saw the bond yield starting to increase. Oops. This is just a more recent. This is, bond yields are very unpredictable. They bounce around. And this is a good slide to show because one of the things we were seeing prior to 2025, right at the end of 2024, the last quarter, we were seeing fixed rates come down. Renzo, we saw some 3.99s, right? Like
Yeah, that's on the insured side specifically. So anyone purchasing a property putting less than 20% down payment, that's typically where you get the best rates on the residential side. Yeah, we got as low as like 3.89, 3.84 at one point, and we were hitting. It was to a point where we were fairly consistently quoting clients, be like, hey, if you're buying less than 20% down, I'll get you a rate that starts with a 3. We had a good 3-week spell there where it was fairly consistent.
And it was with the consistency of the bond yields were low. They were on the trajectory down. If we just look here, they were coming down in 2024. You can see my mouse, right? When I do that or no? I'm circling. Can you guys see? Yeah. Okay, good. Thanks, Paul. So you can see this is where the interest rates were starting to come down. The bond yields were coming down from their previous highs. So we were seeing those low fixed rates. But if you zoom in and you look at it from the last 6 months, you're seeing that the bond yields were bouncing around. They were reacting negatively to the election. You can see this is the US election right around here. And the bond yields started spiking up. The bond yields are sensitive. They'll move on rumor and speculation. We start getting threatened with deportations and tariffs. These are inflationary things. These are things that can drive the bond yields up. So we stopped seeing the same discounts. And why this is important is because fixed rates started to head in a different direction. They don't always move the same way, fixed and variable. Variable rate right now is heading down. It's been heading down for 6 straight meetings. It just moved down at 1.25% in the last 3 months. That's in the last 3 meetings. So we know variable rate is on the way down, but fixed rates right now are bouncing around. They were down and now they're up a little bit. They were coming down a little bit. I think I saw Scotia come out with like a quick close special today. So they're coming a little down. I heard some chatter TD might be coming down on fixed rates, but this is what happens. They're insanely volatile right now, the fixed rates. That's just the way it is, okay? They don't change every day, but we'll see fixed rate changes way more frequently than we'll see variable rate. We get 9 meetings a year from the Bank of Canada, and then we get fixed rates moving, maybe once a month. So that's and they could move more. They could move bi-weekly. So inflation and CPI, this is another important factor, right? If we don't know what inflation is, the increase to the cost of goods, and CPI is our consumer price index. That's how we measure the cost of goods. Now, inflation's important to note. We don't get inflation back, right? I always want to make sure people understand that. And everybody knows inflation goes up, the cost of goods go up. It's not like when inflation comes down, the cost of goods come down. The cost of goods stay up, just the growth at which that price increases. That's what slows down. Now, you need some level of healthy inflation, okay? 2% is a healthy target. That's what Tiff Macklem was saying we needed to be at, right? We need to be back to 2%. We were peaking at 8.1% in 2022. Yeah, was it 2023? I think I got that on the next slide. Hold on.
22 or yeah, 22.
2022. Okay. That's what I thought. Maybe so many dates I got to throw out, Lorenzo.
And that's with their ridiculous calculations.
Correct.
Well, and this is exactly right. I mean, this is with, trusting the government. So
Yeah.
say what you will.
Say no
So
more.
you can see here, this is a year of inflation, right? And if we peaked, I'll show you, I have it on the next slide. You saw, we've been on a trajectory down. So the interest rate increase that we did was done to bring down inflation. We have to get that under control. If you increase people's the cost of or the rate, like their mortgage, their costs, they're not going to spend as much money. Therefore, the money won't flow into the system and inflation will slow down. So we've seen that decrease of inflation, okay? So much so that the last report, we're at 1.8%, and we wanted to be at 2%. We wanted to be at 2% in 2025. That was the prediction, but we hit it early. We hit it in the last quarter of last year. So okay, so this is, again, I went back to like COVID. You can just see this is just, inflation in like June of 2022, 8.1%. And then you can just see the steady decline of inflation, coming down all the way to today to 1.8%. And then it's just interesting if you're wondering, well, what does it look like before COVID in a normal year? Well, this is what inflation looks like. If you look at inflation over the last 10 years, look at how consistent we stay around 2%. It can go down, it can slightly go above. Look at the blip in COVID, right? That's what that is. And what did we do? We dropped interest rates. We had reports that inflation was so low. You don't want negative inflation, means you're not growing as an economy, right? So you can see just the rapid progression of inflation from COVID, right? It's like a skyscraper. It's like a city. And then coming back down. Unemployment, okay? Another one that is, interestingly enough, heavily influenced by the government. How so? Well, we measure the unemployment rate. Okay. Well, the unemployment rate today is at 6.7%. Normal, healthy unemployment is 4 to 5%. 6.7, I mean, it's a signal of a weak economy. But what's even more scary to the economists is the rate at which we measure inflation, because inflation, you're public versus private. Okay, the government should hire. You want the least amount of government activity in your economy, right? You want the private sector to run it. You want small business. You want the people to run. Less government interference, the better. Who do you think is the biggest hiring agent in our country right now? It's the government. The government is hiring the most amount of people. So this unemployment rate, to a lot of people, should be much higher if the government wasn't hiring at the rate they're hiring at right now. Okay, we hire people at 25%. Since Trudeau got into office, I believe, we've hired people, we've hired government. Our government jobs have increased from a 15% up to 25%. We're closer to 25%. Might have to fact check me on that, but I think it's close to that.
No, you're right.
Right. So thank you, Lorenzo. That's why I bring Lorenzo in, right? He's my fact checker. So that's big, right? We want less government interference. So the unemployment numbers in reality should be much higher. Okay. I don't think it takes into consideration anyone who's been laid off either. So it's a lagging number. It's lagging all the time. We know it's likely to get worse. Now people will say, well, it was 6.8% on the last one, and now we're down to 6.7. Isn't that good? Again, the information lags. You're going to see in, a micro view, you're going to see it bounce around a little bit, but from a macro view, you're going to see a similar trend. Unemployment's just going to continue to go up. And that's why, another reason why we have to bring down rates. We have to make it more affordable for people to, have small business and create jobs.
And just to add on here too, like The one thing I just kind of tell people too, and just a common sense way to look at it when the government starts coming out with all these unemployment claims, just look around and see who's hiring. Does anyone know any businesses that are looking for rapid expansion or hiring like crazy, getting loans from banks to try to hire or grow their business? There's not many right now, right? There might be some, obviously, there's always an industry doing well, but to be fair, there's not very many right now. And so whatever the government can come and tell us about their number, we can see that it's unemployment's too high and there's not a lot of businesses hiring. It's a very just look in the economy and kind of see where you're at.
Awesome. Thank you.
Hmm.
So where are rates today? Okay. I had a slide that I would put up. I do a lot of rate presentations, and it's interesting because if I put up a slide of where rates were a year ago, you'd be shocked to where they are now. Okay. Because fixed rates have actually come down quite a bit. A year ago, if you were looking at, I like to focus on the left-hand side of the column. Okay. If you're looking at the left-hand side where it says 589, 544, 419, these ones over here on the left, that's insured mortgages. Okay. Depending on the type of mortgage you're getting, if it's a rental, if it's conventional, all these things, you could have a different interest rate. But high ratio, meaning when you're buying with less than 20% down, that's where you're going to find the most competitive interest rates. So if you're looking at the left-hand side of the column, this 3-year a year ago, 419 was close to like 6% a year ago, right? So we've already seen a massive decrease, in my opinion, to fixed rates. We've seen a 2% decrease to fixed rates in the last year. Variable starting to catch up. You can get prime minus, oh, this wasn't updated, but that's okay. That it happened today. You got to give me a little bit of leeway on that. Prime today is 5.2%. So if we were getting prime minus 1.1%, we'd be at what? 4.6%, right?
4-1.
4.1, sorry. I'm trying to do two different math formulas in my head at the same time, Renzo. Thank you. Oops. So variable is coming back. What's interesting now, and this we haven't seen this in a long time, we're starting to see variable rate become lower than the preferred fixed rate. Okay, for years in my mortgage career, variable rate was always the lower rate. For like 18 years of my mortgage career, variable rate was always lower. Fixed rates were a bit higher, but they were more secure. You could lock in, you knew what you were getting. Variable rate was a bit more, unpredictable, but you got the benefit of a lower rate. Well, for the past, 5 years, we've seen, well, I shouldn't say 5 years, the past 3 years, we've seen variable rate be higher than fixed rate. And that's, when you have things like what we have at the bank, we have an inverted yield curve. And that's an inverted yield curve happens when the cost of the short-term money exceeds the cost of the long-term money. So the 1 year is higher than like the 5 year. Again, that's not normal. In a normal mortgage world, the 1 year is the lower and the 5 year is the higher rate. So we've had this happen. By the way, an inverted yield curve is also a signal that we're headed for a recession. And that's another thing. But it's backwards. It makes it insanely difficult to pick an interest rate, because how do you pick an interest rate a year ago? How do you take a variable rate if you didn't know where variable rates were going and fixed rates were half a point lower? How do you take variable? Some people had the foresight to do that, but most people, and I understand why, but most people were taking the fixed rates because it was more secure, 6%. Lock me in. I don't know where variable is going. I'll take 6%. So with these, up until literally today, I think, Lorenzo, I think now we're going to start to see variable rate lower than the 3-year fixed. And in some cases, maybe close to the 5-year. Like our 3-year right now, on a rental, if we just think of like one of the lenders on a rental, 4.89, 4.79 on a 3-year, Lorenzo. Is that basically what we're looking at?
Mid low fives, and you're still beating it.
Yeah, and what's the variable now? You could get 4.6.
You're going to be about the same right now. You're going to be pretty
that's
close.
my point.
Yeah.
It's the first time in how long that variable rate and fixed rates now are almost equal. So the shift is happening, right? For the last 3 years, most people were taking 1 year, 2 years, and 3 years. I was never really a big fan of the 1 or the 2 year or the 3 year, though had you timed it, any of them could have been good. You know, if you picked the 1 year at the right time, it would have been a good choice. But it was very difficult to pick. But had you chosen the variable rate in the last year, you would have seen that decrease. And some people are stuck with that fixed rate. So I think you're seeing the shift now. Most people are now shifting towards a 5-year fixed rate and a 5-year variable. I haven't seen anybody take a 5-year fixed rate in like maybe one person in the past like 3 years. Nobody was doing it because it was too high and nobody wanted to lock in. Everybody knew rates would eventually come down, so nobody took a 5-year. But we're getting to that point where a lot of economists are thinking that we may be hitting the bottom. Listen, there's a lot of, noise coming from our neighbors to the south, and this noise can create inflation. And if inflation goes crazy, we have to increase interest rates, fixed rates. Now, excuse me, it's different than variable. We believe the trend of variable will continue down due to some of the other things we talked about earlier. But fixed rates are super sensitive. So when they're sensitive like this, and they're close to where people were predicting the low was, by the way, most bank predictions were that fixed rates at the best were going to come down to like 3.5. That was probably going to be best, a more realistic 3.79, 3.89. So you're not far off from where they were predicting rates to be by the summer. And listen, they might go back. To be honest, some people, we even said in our newsletter that it's possible the spring market brings back competition. That's a common thing the banks do in the spring, and we do see fixed rates come down. But my point is, I don't want to dwell too much longer on it. My point is that you're seeing the shift now to more 5-year fixed rates, and we haven't seen that in years because of the volatility and the offer that it presents. This is a healthy rate. 409 was out there in 2019 before COVID happened, and we had a busy real estate market. It was consistent. So I think you have to be super careful when you're picking an interest rate. Picking, you want flexibility. Variable rate, one of the things I just want to mention that one of the things I like about variable rate is you can always convert your variable rate into a fixed rate. Now, there's no qualifying, there's no penalty to do that. You just have, the only condition that the banks have is that you have to lock into a rate that's equal or greater to the amount of years left on your variable. But I like that play for some people. I understand if you're taking a variable rate right now with the hope that fixed rates will come down and you're going to lock it in the next year. I get that. I mean, that's what I'm doing with my variable rate right now. And I don't blame people who lock it in. Lorenzo got a really good rate on his. He could share it if he wants, but he decided.
We did kind of to be fair, we send out tons of emails and we've been saying forever, if you can get 3.99 or lower, lock it in. I was able on my principal residence to get 3.99 and I locked it in. So that's exactly what happened.
And honestly, and we advised, and Dave, my business partner as well, he was doing the same thing. I got a pretty good discount when I got my variable, so the difference isn't as big, but it's really close. Like we're there where people really could consider locking in. So variable 5-year, some people like the 3. I can, you can make the argument for the 3-year. I'm not confident on where rates will be in 3 years. I'd rather have the option of the variable, lock it in a year and just ride myself to like 2030. Just ride that rate all the way through. Okay, so next rate announcements. We had the 1/4 point drop today. We got another rate announcement in March, April, June. These are just the rate announcements. I think we had a cool slide on another presentation that had the bank predictions of where the overnight rate would be by the end of the year.
I can pull it up actually. Hold on.
Yeah, I think Scotia had it at 3%, like that it would stay here. And some of the other lenders were at like 2.25%. It was like 2.5. So still some room to come down. Scotia's sort of known as the bear in this market, right? They're very, they're very conservative in where they think the economy's going. They're just known for that. CIBC.
Want me to share screen, Dan?
Yeah. You want to do it?
Yeah, I got it. Oh, hold on. Can everyone see this?
Yeah, there you go. So that's a cool slide, right? It just shows where interest rates, where the prediction of where that overnight rate will be. Now, remember, the overnight rate is that lending rate between the banks. Prime rate is 2.2% above it. So everybody was basically predicting that we would be down to 3% in the first quarter. And by the fourth quarter of 2025, we'll be somewhere, again, there's Scotia at 3%. And there's our
Scotia is basically saying we're done. Scotia thinks this is it. Rates have dropped, bottomed out, we're done. That's kind of Scotia's opinion on it.
Yeah, yeah. And RBC is known to be a bit more bullish on this sort of thing, and they think that interest rates, that the overnight rate's going to come down to 2%. So, listen, we always say the reality is that it'll probably come somewhere in the middle. BMO probably will be the right one at 2.5, but I think it's gonna continue to come down another 25 to 50 basis points, hopefully another 75, but we'll have to just see. We'll just have to see how these stats continue to roll out. How's inflation? How's unemployment? It's going to be very sensitive.
Oh, unsure.
All right. Oh, make sure I got my presentation. Where is it? Hold on. Oh man, I thought we had a seamless transition for a second, but don't worry, I got it. Why won't it? Hold on, sorry guys. I don't know why it won't let me.
You're back.
I can't find it. Okay, bear with me, guys. Hold on, I don't know what just happened.
No rush.
Thanks, buddy. Why
I mean, yeah, while we wait, so you did see. So I mean, we'll see what ends up happening. But basically, to give everyone an idea, RBC thinks prime rates going down another full percent. So most variable rates are going to be in like the low threes. That's RBC's opinion on it. Scotia thinks we're bottomed out. You're in the low fours, mid to low fours for variables. So that's kind of where. So we'll probably end up somewhere in the middle, where you're going to see a 5-year variable rate in the next basically 6 to 12 months, probably somewhere between 3.5% and 4.5% is probably where we're going to end up landing. Which, again, anything that starts with a 3, in our opinion, in the markets, it's a healthy real estate market at that point. To give you Dan's back, but to give you an idea, anything that starts with a 3 rate, the last time rates were just at a 3% range and kind of stable was 2018, 2019, which, to be honest, was more of a normal real estate market. Prices were going up 5 to 7% a year. You had properties that cash flowed. You had normal kind of economy. So if we can get back to that, we should have a pretty stable real estate market. Now, you're going to end up seeing all of a sudden everything going crazy here in Canada. A lot's changed. So obviously immigration's really affected that. But typically, if you get back to a rate of about between 3 to 4%, you should, or sorry, between mid threes to mid fours, you should have a fairly stable market.
Okay, perfect. Look at that. I got it. Now, let me just do this again. Slideshow. There we go. That was crazy. I lost it all. Okay. Thanks for the time fill there, Lorenzo.
No worries. No worries.
Okay. So, real quick, changes with mortgages. We've had some changes in the last 3 months to mortgage qualifying on the stress test. Okay. Stress test on renewal. So, not everybody knows this. When you have a renewal coming up with your existing bank, they have a really big advantage. Okay. Number one, it's very simple to renew with your bank. If your bank's giving you a good rate and you're not looking to pull any money out, you're not looking to really do anything, restructure, your bank's got a huge advantage because it's super simple. You just pick an interest rate, sign a piece of paper, and you're done. Now, if you wanted to shop around and move that mortgage to another lender, pull out money, qualify for a better rate, whatever it was, you had to qualify at the stress test to do that. Stress test is 2% above the contract rate. So if you were taking a rate of, 5%, you had to qualify to borrow that money at 7%. So one of the changes they said is they're going to get rid of the stress test on renewal to try to make it more competitive for people who are renewing their mortgage to have the ability to shop it to other lenders so they don't feel so stuck with their lender having to qualify at some crazy high rate to go somewhere else. So that's good. That's really good for the consumer. It's going to make it, more competitive. We've used it for sure on some of our deals. I mean, that's an advantage. You're going to qualify for more money. It's easier when you're running it, at the contract rate. It's 2% less, and 2% is a big deal when you're talking debt service numbers, back end stuff. December.
So hold on, Dan. So if
Yes.
my mortgage is coming up this year, so they removed the stress test on renewal, so I can just shop it around and try and beat these guys down.
You can, but you still have to qualify at the new lender. So they're still going to look at, income and, debt service and all of that stuff. But the qualifying rate, because it's a math formula, right? It's basically monthly income divided by monthly debt. And the stress test is based on 2% above the contract. So you take 2% off that contract rate. In theory, you can borrow more money. It makes the qualifying easier.
Okay, so they still have to qualify you. They're
Still
gonna
have to
insure.
For
fully qualify.
investors, it's most investors don't necessarily have trouble just qualifying for a single mortgage. It's more scaling portfolios, different types of properties you're trying to get approved for. That's kind of where the tricks with
Yeah.
investors come in. So it's not something that'll really help a ton of investors. And all honesty, the other thing too, it's not worth most investors' time to, if you got 5 properties, send in all the documents, do all this crazy legwork, pay an appraisal just to get over to a new bank and save $45 a month, right? That's most
No,
of the
it's
time
not worth it.
investors don't look at that. If you're trying to pull
I'm
money out, then you got to requalify normally though, right? So it's really designed just for like single guy, like just a wife and husband, they have regular jobs, they own one house, like that kind of thing. For investors, not one again, it's great if we need it, but it doesn't necessarily always make tons of sense for them.
Yeah, I'm thinking about my personal home here. I gotta stick it back to these guys.
Yeah, we'll get them. We'll get them.
We'll get it, buddy. December 15th, CMHC made a big change. They allowed first-time home buyers the ability to take a 30-year amortization on an insured mortgage. So previously, if you were buying property and you had less than 20% down, the maximum amortization you could take was 25 years. They've upped that to 30 years. So not only does that improve cash flow for the potential buyer, but it also increases the pre-approval a little bit. Okay, you get a little bit extra borrowing power with a 30-year am. Now, what's important to note is as well in this is what's a first-time home buyer? First-time home buyer doesn't have to be your first time buying a house. You can be a first-time home buyer if you're going through a separation or a divorce. Okay, it has to be finalized, but coming out of that, you can qualify as a first-time home buyer. And I believe it's 4 years. If you don't own a home for 4 years, 5 years, thank you, Lorenzo, 5 years, you can requalify as a first-time home buyer. Okay, and that gives you the benefit of being able to take money out of. People think that 5% down means first-time home buyer. It doesn't. 5% down has nothing to do with being a first-time home buyer. First-time home buyer, you'll get the 30-year AM. You can pull money from your RRSPs. You get a break on land transfer tax. You can put money into the first-time home buyer savings account. So it's those kinds of benefits. Okay. Lorenzo's favorite, the CMHC. What was that one called again, Lorenzo? Where they give you half the down payment.
Oh, I can't even remember what it was called. The first time home buyer incentive program.
That's it, the incentive program where the government would give you
Own
some
your
of the
house
down
with
payment, but they wanted equity in your house. And we didn't sell any of those. Okay. Refinance. This is a big one too. So this was of January 15th, 2025. You can now, on owner occupied, unfortunately, for all the investors in here, it doesn't apply to rental properties, but owner occupied properties, traditionally, we've only ever been able to refinance to 80%, right? Back in 2003, they made the change. You used to be able to refinance up to 95%, but they made the change back. I think it was like 2003, 2004, where you couldn't refinance past 80%. So now with CMHC, if the funds went towards adding an additional unit, duplex, triplex, garden suite, ADU, you now have the ability to refinance through CMHC and pull out 90% of that cost. Okay, 90% of the value, I should say, sorry, 90% of the value of the home. Now it comes with an insurance premium. It's a reimbursement program, so they don't give you the money up front to do the renovations, but they will reimburse you up to 90%. And then CMHC, previously, this was, I think, November of last year. You could only go up to, if you were buying with less than 20% down, you could only go up to a purchase price of $999,999.99. Now you can go up to $1.5 million. So if you have the minimum down payment, which would be 5% down on 500K, and then 10% down on the amount above that. So if you have 125,000, you can go and buy up to $1.5 million now through CMHC.
And qualify for $1,375,000.
Yeah, Renzo, real quick, what's the income with no debt you'd have to show
it's
on
like
that? About
250 or
300K,
something.
right?
Yeah, it's like 250,
350.
300. Yeah, your mortgage payment's like probably 10 grand a month, 11 grand a month.
Now, listen, in fairness, I've actually had clients doing that. So you're right. It sounds crazy. It's one of those things where if you're buying in the GTA, it's very possible. You know what I mean?
Yeah.
You're buying in the anything outside of there, it's going to sound a little nutty. I like the other one where Trudeau allowed us first-time home buyers to pull out up to $65,000 on your RRSPs. Now, aside from the, maybe somebody going through a divorce or something like that where it can apply, not a lot of first-time home buyers have $65,000 in their RSPs. So makes it a little bit more difficult. They say they're building programs, and it's hard to. I'm not trying to knock the government. You can knock the government for a lot of stuff, but I mean, listen, positive measures is something that, Paul, we haven't seen in a long time. And we've been in real estate a long time, you and I. We've only ever seen them try to make it harder to qualify a mortgage. And in a lot of ways it is. It's still getting harder. But they are coming out with some programs to try to make it more affordable and help people buy and shop. So we got to give them some credit, right?
Yeah, I think the
We don't
pendulum
want
is swinging. The pendulum is swinging, and it's probably going to keep swinging our way.
Yeah, I think so. I mean,
Patience.
listen, we're entering a new era where they're going to need to do things to help people qualify. They're going to need to.
Yep.
Okay, listen, I've talked enough. Renzo, you take over, walk
Yes.
everybody through the CMHC changes, and yeah, go ahead.
So yeah, I'm sure everyone's kind of very familiar with CMHC MLI Select already. So I kind of wanted to highlight some new changes to the MLI Select program that had come out and kind of go over one of the changes that hasn't, in my opinion, been talked about enough, but is actually the biggest one. So first thing, starting off, obviously, as of June 2024, CMHC, they came out with new rules, obviously mainly surrounding the MLI Select program, but also, and one of the key ones was around just in general, doing a refinance with CMHC, whether it's a normal CMHC deal or going through MLI Select. And so what used to happen prior to last June was that people would have a property. Now, let's say you were doing a construction deal and you bought a big property, or you're doing a big renovation. So you bought a piece of property, converted it from 5 units into 9 units. You had to get some private money to do so because the banks weren't great to finance it. So you took a private lender on. The idea was you got them for a year, got your project done, and then we're looking for an exit from CMHC to pay out all of that money, and then obviously be able to get a good interest rate and the property starts cash flowing. So what CMHC originally had was, if you were someone that did that project, they would then make you sit in that private mortgage or go to a CMHC approved lender through a private mortgage effectively for 2 full years prior to going to CMHC and actually getting the real refinance. So what was happening here, and this is kind of the craziness of it all, is that so CMHC had rules, they were only paying out CMHC approved lenders. So what's a CMHC approved lender? Is basically a bank, trust companies, so some large hedge funds that have mortgage arms to them. And so what would end up happening is that you would do your financing through a private mortgage originally to build the property or to close super fast or to do all the renovations, because typically that's the best way to finance those deals. Then you would have to go find another private mortgage through one of these CMHC approved lenders that would charge you another 2% lender fee and a 10% interest rate. They would then force you to sit in it for 2 full years, and then you could go and refinance the CMHC. So this made it for the longest time super difficult for a lot obviously just normal people like us. Like, how are we supposed to make our numbers work sitting in a private mortgage for an extra 2 years? Made it super difficult. There was tons of complaints, and they were really doing that in an effort to slow people down, because they were just getting behind with all their backlog, even though they have 1 million employees. Because everyone was using it, and so they were getting behind. So they set this 2-year rule to try to slow the amount of applications coming in. That was really all it was for. So anyways, finally they got rid of that rule. So now let's say you were someone who bought a property, did a bunch of rentals, took private money to do it, for example, borrowed money from friends or family, kind of scraped and scrunched to get it done. You can now go right away to CMHC. They'll pay out all those existing lenders. There's no bridge that you had to get that just ended up costing a bunch more money in fees. So it made it a lot better for normal investors like ourselves to be able to use a CMHC process and make it more cost effective. The other thing too is that, as we know, CMHC takes forever to fund a deal. You're looking at 3 months at the minimum. Sometimes can go 6, 9 months, depending how complicated the deal is. But you're looking usually around a 3 to 4 month process. Well, if you're trying to be competitive and offer on a property, typically going to a seller and saying, hey, give me a 5-month closing isn't the best thing to do. So a lot of people do quick closes, close with a private mortgage, and then, or a quick mortgage. Again, they have cash, friends or family, refinance their house. things like that. They close quickly with the knowledge that they're going to pay it off when CMHC comes through. So this allowed them to rebudget numbers better as well, to say, listen, I'm only going to be in these higher interest mortgages or these bridge loans for a very short period of time, only a couple months, versus having to stay in it for 2 full years. So that for us as obviously investors, especially that we're probably not sitting on tens of millions of dollars to close cash on things, made it a lot more attainable and made CMHC start to make a lot more sense for us too. And then, so yeah, so the MLI Select. So one other thing that happened in June is that they changed the scoring system on how MLI Select works. So just to kind of recap before we kind of go into the scoring here, the way MLI Select works is it's a normal qualification with CMHC. You have to qualify based on the cash flow of the asset. However, they will give you points if you hit certain criteria. So the first criteria is what's called affordable rents. And basically what that is CMHC came out with basically what they think the median income for every place in Canada is for every person. And what they say is your rent, someone's rent payment, for it to be affordable, cannot be more than 30% of that income. So let's just, for easy numbers, let's say the median income in Toronto was $100,000. They will then say 30% of that number is 30 grand a year. So then you cannot pay more, or someone to have affordable rent cannot be paying more than $30,000 a year in rent, which is $2,500 a month. So the more property or more units in your building you had under $2,500 a month in this example, the more points you would get toward the affordability. It'll allow you to get up to 100. The other one was accessibility. This was very rarely used for the longest time. It's basically having wheelchair ramps, wide hallways, large doors, just making it accessible for disabled people. It's typically very expensive to do, and which is why it was not something that was commonly done. And the third one that everyone used to do because it was the easiest and it got you the full 100 points was through energy efficiency. And so what would happen is if you effectively, and to be honest, between all of us, it was something where we had a good engineering team on site, and they would effectively say the property that you have is much more energy efficient than CMHC standards, and you would then qualify for the full 100 points. Now, what they ended up doing, they made changes. CMHC realized that everybody was just abusing the energy efficiency section of the scoring system. So they maxed it to say the most amount of points you can get for energy efficiency is now only 50. So effectively, if you're someone's going to MLI Select, you can only apply through energy efficiency. Maybe you don't have accessibility or affordable rents. You're now going to be stuck at a 50-point score system. So they're trying to incentivize people to get obviously a better loan to value and a longer amortization. They're trying to incentivize you to either make more affordable units, what they consider affordable, or they're trying to incentivize you to make more accessible units. The other piece to this, if you want to make your units affordable, it's not something where we just say, hey, CMHC, our unit's $2,500, don't worry about it. And then next year we jack it up. They actually make you guarantee you'll do it for 10 years, and then they audit you every year to double check that you are doing it. Now, is there ways around it? Yes, probably, but it just, there are
Lorenzo, I did learn something about the affordable. So,
yes.
they tell you what they want the rent to be, but like on the Ontario standard lease, you have the base rent,
Yes.
right? So the base rent needs to be that amount.
Correct.
But who's to say your tenant doesn't want to pay you for storage or parking
Yep.
or use of the backyard or any other extras? So they're allowed to pay you for extras, and that's one way you can kind of maybe not
100%.
make up all the difference, but maybe some of the difference.
Yes, yeah. So there is definitely ways to do it. You're absolutely right. There's been a lot, like there is definitely ways to do it. I've also, to be honest, just had people with two sets of basically rent rolls, and so just to be fully transparent here, so one's one and one's another one, right? So, but yeah, there is definitely ways to do it as well through the parking, especially with bigger units. If you have parking at your place, that's a huge one. I've also, yeah, so you're absolutely right. Storage, you absolutely can make it up. So there is little ways to be able to kind of do it because you're right. They are only looking at just the base rent amount. So you're absolutely right there. And so, yeah, so effectively now where you're at is that if you get the full 100 points or you're using multiple programs or multiple programs through the scoring system, you can get up to 95% loan to value and a 50-year amortization. If you're someone hitting basically 50 points, you're looking at still 95% loan to value on a new build or in a 40-year AM. If you're going to 50 points on an existing property, you're 85% loan to value in a 40-year AM. Now, someone might say, hey, well, if 85 loan to value and a 40-year AM on an existing property, I could get that through the standard CMHC program, which is true. The only difference here is that the MLI Select, so when CMHC qualifies you, they qualify you based on the cash flow of a property. As soon as you say you're applying through MLI Select, they will allow you to basically have a lesser cash flow, which allows you to get a larger mortgage amount, which is something typically we all want. So typically on standard CMHC, you have to have basically a 30% cash flow, basically income versus expenses. For every dollar in expenses, you got to have about $1.20 to $1.30 in income. For MLI Select, for every dollar in expenses, they only really want to see $1.10 in income. So even though you're basically getting the same loan to value in AM, let's just say your property numbers are tight and maybe you can't get there on a normal CMHC deal because your numbers are a little bit tighter. The MLI Select does allow for less cash flow to still get those higher mortgage amounts. And then one thing also people might not obviously realize too is if everyone sees where it says recourse, oh sorry Dan, there's one more, just where it says recourse there and it has limited and full. Basically what that means is that depending on the size of your mortgage, the recourse from CMHC will be limited potentially. So full recourse means the lender will come after you for all the money if you don't make the payments. Limited, basically what they'll say is you're on the hook for only 40% personally if you don't make the payments. Your corporation's still going to come after you, but you personally, if you're a guarantor, you're only on the hook for a portion. Usually it's around 40 to 60% depending on the deal of the actual mortgage. So just something cool because personal guarantees are always huge that if you can get kind of limited, it's just kind of steps in the right direction. And there's my spiel.
So just a small note on the MLI and CMHC thing. Like I wanted Lorenzo to talk about this because with all, I guess I've been around long enough, I'm showing my age, that with every market shift, some doors and windows close and other doors and windows open. And with the recent shift we've had, some strategies that we've been used to kind of not maybe stopped working, but stopped working as well. But one thing that continues to work well is the MLI program. So, I mean, it requires a little bit more capital, and I would say, a slightly higher sophistication, but it's not rocket science. Like it's just, it was like, let's say 7 or 8 years ago when we were starting to learn how to do duplex conversions. It required a little bit more sophistication. We had to figure out some hurdles, and there were some obstacles, the cities and stuff like that. But within a few months, everything kind of worked out. And then one person did it, and then two, and then 10, and then 20, and then, and the snowball came. So that's what's happening with MLI. And, given the government's mandate to promote more rental housing building, they've made the program easier for, let's say, smaller and medium investors who want to build a 5 unit, a 6 unit, a 10 unit, a 12 unit. Nothing, it doesn't have to be 50, 60, 80, or 100 units. So it's something to pay attention to if you do want to do some bigger stuff and get your money back in the market. It's what I've been doing. I have one project I just finished, two more on the go, and another project where I'm the money partner. Like I know these other ones, I'm the one building and doing everything, but another one I'm a money partner. So the money's there, and if you want to learn more about it, just reach out to me, and we'll chat. But why don't we?
Too, or you'll say it
exactly.
Too. Yeah.
They force you to cash flow. You got no choice. So if anyone has questions, just unmute yourself. I'll just start with one. Oftentimes I'm asking, where's the CMHC rate, and it keeps floating with, the our fixed rates. So what's the best indicator to watch to know kind of where the CMHC rate is on it?
A really good question because there's a common misconception that the CMHC rates are based off the bond yield. So people will go and look at bond yields and that's where they think the rate is. It's actually incorrect. So there's two, when you look at bonds, there's a yield and then there's the actual bond rate. So the CMHC, so while fixed rates on the residential are based off the bond yield, the CMHC rates, the fixed rates, are actually based off the bond rate itself. So that rate's actually higher than the bond yield. So the bond rate right now, I think today it was actually just at 3% on a 5-year. And so the way these rates are priced is depending on your deal, loan size and everything, you're typically between 60 and like 110 basis points above the bond rate on CMHC. So to give everyone an idea, I just did one.
Above the 5-year bond rate?
Correct. But depends what term you take. So you take 5 or 10 years, it's just whatever that one is. And
I mean,
most people take 5.
Assuming most people take 5, so it's the 5-year CMB.
Exactly. So it's exactly what it is. And so to give you an idea, so if you're closing one today, and let's say, and again, it's all about loan size too for the lenders. So let's just say your loan size is usually around three to 4 million. You're gonna have a rate that starts with a three in front of it, like almost guaranteed. It might be mid to high three. I just did one, and it was actually when the bond rates were a little bit higher right before Christmas, or no, sorry, right after Christmas when the bond rates were increased a bit, and it was bond yield plus or bond rate, sorry, plus 90, and we ended up finishing off at like 4.1%. Right. And so they're,
Yeah.
again, not bad, but to give you an idea, the rates are very competitive, especially compared to the residential side. But yeah, it's a common misconception that people just watch the bond yields and think it's the same. It's actually the opposite. Watch the actual Canadian CMB rate, and that's how your pricing is going to be based.
Plus 0.6 to 1.1.
Yeah, correct.
Okay. Okay. So now I don't have to bug this guy.
Yeah, and then the other thing
All
too,
right.
actually, the crazy part about it, the way these things get priced is when you get your first kind of, they call it like a letter of intent, is so when you apply to a lender for CMHC, the first piece to it is to go to a lender and see if they'll even take your deal. And they'll give you a letter of intent that basically says, yes, we'll bring this deal to CMHC with you, and we'll fund it once CMHC gives you their go ahead, and it's just called a COI, certificate of insurance. And what they'll do is they'll say, we'll guarantee your rate is CMB plus 60, 70, 100, whatever the number is. And so all you know the whole time is that your rate is the mortgage bond plus a certain number. The actual rate doesn't get set until 24 to 48 hours before closing. Sometimes 72, but 24 to 48 hours before closing. And so what happens is you have a window. And so basically the lender will say, okay, we're going to go down and buy the bond today because they're physically buying the bonds, kind of like an old school trading thing. Be ready. You have 7 minutes to lock it in. So I'll be sitting on the phone. I'll call my client, say, stay on the line. I'm going to call you in 5 minutes or send you an email, get ready. And they'll be on the ready. And I'll say, okay, bond's been bought. We have 7 minutes. Do you confirm? Here's your rate. Yes, confirm. Okay, good. Rate's been locked in. And you close within 2-3 days. So there's a little bit of unknown the whole way through. You're always going to have a pretty good idea of what you're going to get. It's not like you're buying the Nvidia stock and it's just flying and all that kind of stuff. But you'll have a good idea. But yeah, it doesn't actually get set. So it's something to keep an eye out for.
Okay. Victor's got a question. Maybe it's on a few people's mind. Please share your thoughts on how import tariffs on Canadian goods will affect fixed and variable rates.
So yeah, it's actually a really good question
Yeah.
too. It's something that we've been talking about. So tariffs in themselves are inflationary because what that basically means is regardless of Canadians are spending more and accumulating more things, that tariffs are going to make our cost of goods more expensive. So and that's why Dan mentioned earlier, like we're uncertain about where the rates are going to be in the next 2 to 3 years. We know we have a window to lock in, and that's why we suggest to take it. Because yeah, if Trump does hit us with all these large tariffs and they do stay, it is something that is definitely inflationary. Our cost of goods will go up. So it's definitely inflationary. There are big worry, and I guess as Canadians, we should be kind of not losing sleep over maybe, but definitely something to consider is that even though inflation's going up, typically what that means is that the economy's rocking. That's why inflation's flying. And that's kind of what happened in 2022. The economy was rocking, inflation was flying. They raised rates to bring it down. Problem in this situation is if they start hitting us with super big tariffs, inflation starts going back up. Our economy's not doing that great. Like our GDP is still down, unemployment's still up. And so that's when you start to hit what's called stagflation. So it's just something to keep, not that we're going to hit it or anything, but it's just something to keep an eye out for that these tariffs, if they come hot and heavy, basically, who knows what's going to happen, but we'll see. It's something that, yes, could obviously raise interest rates, but then also could have like an impact on interest rates where they start going up. So again, the idea is try to lock in if you get something good.
Renzo's bang on. So just to like, if you don't mind, I'm just gonna dumb it down a little bit. So the cost of goods is what happens is when these if we get the threat of tariffs, then the cost of our productivity will go up. The cost of the productivity, right? The cost of the businesses, everything's going to go up with these tariffs. That cost gets passed on to the consumer. So the cost of goods starts to go up, and that's the inflationary thing. Now, to Lorenzo's point, you'd think that, okay, well, isn't that in some ways the economy's rocking? Not necessarily, because in this type of economy with inflation, if the cause of inflation is because of tariffs, well, then you're also going to see an increase in unemployment because spending's down. So you're going to have inflation heading one direction and unemployment heading the same direction. And that's bad overall, right? So that, and then of course that's the correlation of the unemployment too, right? Is that unemployment will go up, and then we could find ourselves in another, depression eventually, and you don't want that. I mean, all of these recessions and depressions, it shakes out the middle class, and that's the middle class is what runs the economy. That's the lifeblood of the economy. So you can't shake that out. You can't have these over and over. You can't every few years have a recession or a depression, anything like. You just can't have that repeatedly. It just shakes out the middle class. So we have to cater to the middle class. That's what we do. We just walk this narrow line of keeping inflation at a certain point where the middle class can succeed.
And not to make it sound all doom and gloom too, I really don't think it's that bad to be I'm not like, oh, stagflation's coming, everyone get ready. Like it's not nothing like that necessarily. It's just something to keep an eye out for. Like long term, I'm very optimistic. Like I think like over a 10-year cycle, buying real estate, buying good assets, like you're gonna be so far ahead of every people that don't. It will be crazy. So I'm optimistic long term. Just something over the short term to keep in mind. That's why we say kind of the next 2-3 years will be interesting.
Yeah, Canada needs some pressure to turn on the machines and start working again.
Yeah, start drilling.
So yeah, exactly. Start drilling, start building, start doing anything. Get off your ass. So we got to cut it at 8:30. But I'll send this recording to everyone. I'll give you Lorenzo's and Dan's contact if you don't already have it already. And you guys reach out to them if you have questions. And now is the best time of year to kind of get your interest rate strategy set, so you know what's going on for upcoming renewals, upcoming mortgages. You're going to sell a property, you're going to buy another property, whatever it is you have going on. You want to plan for it. The last thing you want to do is sell your property and then wake up and say, oh, what should I do now? Like, you got to plan for this stuff ahead of time. That's what the best investors do. Okay.
And sorry, just one more thing. I just saw Victor's question because you're absolutely right. But yeah, sorry, I did skip ahead. It's assuming that we match their tariff, which if we don't, that would just be crazy as well, to be honest. Because yes, you are right. If the US just tariffs us and we just sit there and take it, then technically that doesn't raise our inflation. It's assuming we do start tariffing them. You're in a tariff war though, so I don't know how you don't do anything back, to be honest with you. But yeah, anyway, that's a whole different part.
Yeah. Good luck winning a tariff war with the US.
Yeah, that's the other thing too. So, but yes.
Yeah, Trudeau versus Trump. I'm gonna take that bet.
Yeah,
I think that battle's already over, isn't it?
Yeah, actually, right.
That was already
Anyway,
over.
who wants to talk about those clowns?
Yeah.
But I appreciate you guys coming on. Hopefully this is valuable for everyone, and I'll send out the recording to everyone else waiting. Okay, take care, everyone. Ciao, ciao.
Awesome. Thanks, buddy. See you guys.
See you guys.
Victor, I'm going variable, buddy. Follow me.